Let's talk about the biggest buyer mistakes when it comes down to actually getting a loan. You definitely don't want to do these things. These are things that I've learned through experience. And if you do any of these items, there's a very good chance that your loan is going to blow up. My name is Zevi Shafran. I'm an owner of a wholesale mortgage company in Los Angeles called Loanbrook Inc. And I want to share this information with you because these are mistakes that I've seen many borrowers make, and I sure hope you don't make them yourself. All right, so with that, let's get started. Mistake number one, when you're trying to get a loan to purchase a property, the first thing you want to do, which is huge, and you might think it's pretty obvious, but you don't want to quit your job. All right, I've had borrowers in the transaction actually changing jobs. Now, the thing is, even if the new job pays you more than the old job, you gotta be transparent and let your loan officer know that you're in the middle of changing jobs. Because if you don't, what's going to happen is the lender is gonna do a verification of employment. And when they do that, your HR is actually gonna say that you're not gonna be there for much longer. Remember, the lender is counting on continuance. So even if you showed a pay stub, an HR or verification of employment says that you're leaving in the next 30 to 60 days, how are you going to get a loan? That's a really big problem. So whether you're about to change jobs or quit your job, you need to let your lender know this ASAP. Now, there's another piece to this puzzle, which is really important. Depending on what your job is, meaning if you work on bonus and commission, and let me explain that to you, because there is a 2-year requirement for somebody to get credit for their bonus and commission income. And so if you do not have a 2-year history, or if you're leaving a job that the majority of your income comes from bonus and commissions, and you're going to another job that might not have that, you're going to lose that piece of your income, and it might cause you not to be able to get qualified. All right. So that's a really big thing, and you definitely want to be very careful about doing that. So I would say that's definitely number one. Number two, which is I think just as big, is extending credit. Okay, you're in the transaction and you're thinking, okay, they already ran my credit. Now I'm going to go to whatever, the fancy car dealership. I'm going to go ahead and buy myself or lease myself a BMW, a Mercedes. That's a hefty payment. If you add that into your ratios, there's a very good chance that you're not going to qualify. And so you might be thinking, yeah, but they already read my credit. I'm off to the finish line. It's not true. Because what happens is, before the lender funds your loan, they actually do a soft pull. And the soft pull doesn't hit your credit like a hard inquiry, but it actually tells the lender whether you've extended any other debt. And if you have, then they're going to ask you for that monthly liability. And if it's not included in your ratios, they're going to include it. And if that bumps you above the qualifying ratios, three things might happen. Either you don't qualify, either you have to reduce the loan amount, or something else that just slipped my mind. All right, but you're going to put yourself in a position where you don't want to be in it. So just simply don't do it. Number 3 on our list is going to be transferring money between accounts. Mind you that when you go to get a loan, you need to document where your money is coming from. There's a reason why the lender says that they want to say 60-day seasoning, that the funds have been in the account for at least 2 months, meaning that you've provided 2 months worth of bank statement and we haven't seen a massive deposit coming into your account, call it the down payment. Why not? Because then there's a good chance it's not your money. And if it's not your money, that's okay if you're doing an owner-occupied deal, but then we need a gift fund. If something came into your account, imagine this, you make $5,000 a month. We see a deposit for $50,000. Clearly it didn't come from your job. So where did it come from? Right? We have to document those transfers. Now, if the money's been there for 60 days, 90 days, and you give us 2 months worth of bank statement, no one sees a large deposit, cool, it's been seasoned for 60 days, we move on. But If there's a large deposit coming in, we're going to ask, where did this deposit come from? And if you're like, all right, well, I have 10 different accounts, I'm going to start shifting money around to make sure I have this down payment, that might be really tricky. So I would hold tight before I would do that, because I advise my borrowers to basically transfer the down payment directly to escrow, right? If you're going to have to do a bunch of transfers to get that into an account, I would highly consult with your loan officer before you start doing that, so it doesn't get sticky. And the reason is, you're going to provide these bank statements to the lender to show that you have money, and then all of a sudden, this one account has a whole lot more money than what it says on the statement, and they're not going to understand where it came from. So you're going to have to document all the transfers that you did to show that that's where the money came from for the down payment. It gets a little complicated. I would say not a great idea to do that, all right? Make sure that you're transparent, all right? Transparent with your information, because the last thing you want to do is provide information that's not accurate. That's a really bad way to go, all right? No client that I ever work with, to my knowledge, has ever provided me fraudulent information. And if they did, then I would cancel that loan immediately, and I would never work with them, because you have to be very transparent. All these things that you're providing to your lender are going to get verified. All right, so make sure you're transparent. And then lastly, if you in fact introduce these accounts that have money that you're going to send off to, the lender for a down payment, don't introduce new accounts, meaning that, say we know that your down payment is coming from account ending in 1234, as an example. And then all of a sudden your down payment comes to escrow at closing, right after you sign your loan docs and you have to wire in your money, comes from like a completely different account. Well, the lender's going to get confused. Well, we didn't talk about this account. We don't even know that it exists. Where is this money coming from? So that's another thing you got to be careful of, all right? Don't introduce new accounts. Whatever accounts you want to use, make sure you introduce them to the lender, get them sourced, get them checked off, so they know those are your accounts that you're going to be using to complete your transaction, all right? Hopefully this gives you a little bit of an insight of what not to do when you're trying to get a mortgage. If you need extra assistance with any of this, I would totally appreciate it if you reached out. My number is 818-697-8220. Feel free to reach out with any questions that you have. I'll be happy to help you. You're also welcome to drop your questions in the comments below. I'll do my best to answer them. If you've enjoyed the video, please make sure to give it a thumbs up, like it, so we can get a little boost in the algorithm. Hopefully other people like yourself who are looking to take advantage of this information can find it. And then lastly, if you enjoy videos like this, then please make sure to subscribe to my channel. You'll see more videos like this periodically, all right? We do load videos weekly. So with that, I thank you so much for watching this, and I look forward to seeing you again on the next video. Take care.